Hey guys, it's Chad Larson, and welcome to another episode of MLD Money Matters, your go-to podcast for all things market related. I'm your host, Chad Larson, Senior Portfolio Manager at MLD Wealth. Today, we'll be diving into latest market updates, discussing key elements that shaped the market last month, and taking a closer look at the first quarterly results of the Alternative Private Income Portfolio, a unique offering designed exclusively for our clients at MLD. Jumping back thing, listen, November was a quite eventful month. Despite greater clarity from central banks, interest rates spiked higher, particularly in the US, driven by stronger than expected economic data. And obviously, as we were watching with the increasing odds of a Republican Party victory. So while US GDP remained healthy, Canada's growth showed some vulnerability, leading to a divergence between the two economies. The Bank of Canada accelerated its rate cutting cycle, focusing on restoring growth as Canada inflation seemed under control. Rising yields and the election uncertainty weighing into traditional fixed income prior to the election and equity returns, with both asset classes finishing October in the red. However, credit spreads remained resilient amid broader volatility, finishing the month strong due to robust fundamental and technical backdrop for corporate bonds. The market reacted extremely positively to the Republican Party's victory, with risk assets like credit spreads and equities rallying. And here came the Trump bump. This rally was likely due to the market's preference for Republican policies and relief from the swift resolution of economic uncertainty. So many people, myself included, thought that we wouldn't have a decisive winner one way or the other post the election, but it was a red wave across all aspects of the government. So incoming Republican Party, what markets really don't like is uncertainty, but we have certainty of economic policy. Wanted to talk a little bit about the Alterna private income portfolio. This portfolio, as I mentioned earlier, was designed exclusively for MLD clients, aiming to generate attractive long-term risk-adjusted returns with consistent income generated by investing in a diversified portfolio of alternative investments, including private credit, real assets, private equity, and hedge funds. I'm thrilled to share that the portfolio performed very well in its first quarter. For clients receiving income, the portfolio made its first distribution. We pegged the distribution annualized at 6%, so clients received a 1.5% distribution, while for others, the portfolio continues to compound their growth. These results reaffirm the portfolio's ability to balance reliable income with capital growth. One of the standout features of the alternative private income portfolio is its access to world-class managers and investment firms, many of which are not available anywhere else in Canada. This exclusive access allows our clients to benefit from top-tier investment strategies and expertise, enhancing the overall performance and more so the resilience of their portfolios. Wanted to take some time and look ahead and discuss some future market predictions as we approach the end of the year. As always, in January, I'll come back to you and go up high on my mountain and make some predictions of what we see, through the calendar year. But the Federal Reserve stance on interest rates remains a critical factor. While inflation has peaked, the labor market continues to show strength, suggesting that the Fed may not pivot quickly to ease monetary policies. So investors should still focus on strategic positioning for an extended period of higher rates in the US. Additionally, the global economic landscape is expected to remain challenging, with potential headwinds from geopolitical tensions and economic slowdowns in key regions. However, there's also opportunities. For instance, we see a lot of attractive investment opportunities due to valuation bifurcations across international markets, and continue to show attractive investment theses due to growth potentials and alignments with long-term trends. As always, sticking with the thesis, we see a synchronized global recovery into an incoming new presidency in the US. There will be some order on the border. There will be some more clarity. The new rocket man is in place, and the market is generally done incredibly well through those periods. We also still have an abhorrent amount of cash on the sidelines through this last tightening phase of higher interest rates. I think the last time I checked, there was still north of $10 trillion of cash sitting on the sidelines between money markets, commercial deposits, treasury bills, etc., in retail portfolios. So a lot of cash to continue to pour into the cycle. And then, as well, the third kind of part of the thematic is the advent of efficiencies across all corporate balance sheets through the implementation of artificial intelligence. I've said this many times before. You don't have to be just NVIDIA to benefit from the artificial intelligence trade. Artificial intelligence used in the most boring of businesses. It could be shipping, a railroad company. The implementation of AI enhancing delivery schedules, enhancing efficiencies, enhancing processes through finance departments, through procurement departments, is going to continue to increase RevPAR, revenue per employee, and other metrics that will cascade themselves down to the balance sheets and ultimately to earnings per share. Today was interesting. So if we're late, at least we have a little bit more news. The Bank of Canada announced a significant interest rate cut, lowering the rate by 50 basis points to 3.25%. This move is aimed at supporting economic growth and keeping inflation closer to target range. However, this rate cut has also impacted the Canadian dollar, which has weakened against the US dollar. Last time I had looked, in the last quarter, the US dollar has appreciated vis-a-vis the Canadian dollar by almost 5%. We've been pounding the table for a long time all throughout the year, albeit hard to trade dollars here. The Canadian dollar continues to suffer and don't know where it's going to stop. The Canadian dollar has faced significant pressure due to the divergence in economic growth between Canada and the US. The Bank of Canada's accelerated rate cutting cycle. Despite these challenges, foreign flows into Canada have surged, driven by some strong equity and bond market returns, which has helped Canada hold its own in that 70 range. But the weakening of the dollar is going to have severe implications for the economy. On one hand, it makes Canadian exports more competitive, potentially boosting manufacturing and export sectors. On the other hand, it increases the cost of imports, which can contribute to inflationary pressures. For investors, it's essential to consider the impact of currency fluctuations on their portfolios and explore strategies to mitigate these risks. On that same vein, another important topic in the market is the tariff narrative due to Donald Trump's comments about imposing tariffs on Canada. Trump has threatened to impose a 25% tariff on all goods from Canada, which could have a significant impact to the Canadian economy. This move has created uncertainty and could impact trade relations between the two countries. Justin Trudeau was just down in Mar-a-Lago visiting Donald Trump. And furthermore to that, Trump has made some interesting comments on Truth Social, effectively referring to Justin Trudeau as a governor, as that Canada is just being another state of the United States. But tariffs can have a ripple effect on various sectors, including manufacturing, agricultural, and retail. And for instance, higher tariffs on Canadian goods could lead to increased costs for U.S. consumers and businesses, potentially reducing the demand for our exports. Conversely, Canadian businesses may seek alternative markets to mitigate the impacts of tariffs, leading to shifts in trade patterns and supply chains. So lots is going on, as always. Thematically, very comfortable with how portfolios are positioned. Sector by sector, we're seeing opportunities. Certain sectors we like more than others and continue to maintain overweight strategies. As discussed, we had reduced our weighting to energy, was more constructive, the balance sheets and the valuations of energy companies, but more concerned about the price of the commodity. I want to discuss how global markets affect domestic markets and how they're correlated. Global events such as geopolitical tensions, economic policies, and natural disasters even can significantly influence market dynamics. For instance, trade tensions between major economies can affect global supply chains, and we've seen that over the last 4 years, and additionally increasing into market sentiment. Similarly, economic slowdowns in key regions can create headwinds for global growth. And due to the potential to align with long-term trends, we remain cautious on deployment into some segments of the marketplace. Security selection is going to, we feel, be the differentiating factor going through the next market cycle. We've been talking for a long time. Tech has really driven the bus and grabbed the market and gripped the market forward, while sectors like real estate, have dragged the market lower. But giving these interconnected dynamics, the inclusion, to hammer this point home, the inclusion of alternative investments and having a broadly diversified portfolio makes absolute sense. Diversifying into the other subspecies of within the alternative investment landscape, such as private credit, real assets, private equity, and hedge funds, provides opportunities to generate returns independently of the broader market, which can enhance overall performance, but also meaningfully reduce the volatility and correlation of the markets. This approach is obviously helping mitigate risks and to help clients achieve long-term goals. One of the things I've decided to try to do is on a go-forward basis, just maybe spend a couple minutes as an ad lib and talk about some things we see long term on the horizon. Years ago, it was very apparent things like artificial intelligence were going to make impacts into the market. No one knew how big they would be or where those chips would land. But I wanted to spend a few minutes talking about something that's very high up on my radar and blipping very bigly. Bigly, that's not a word, but we'll use it for today. I don't feel like editing this. I want to talk about and explore the emerging use of peptide therapies and their potential impact on longevity in the healthcare industry. Peptides are starting to get a lot of attention. We've seen them heavily regulated into the US, in Canada as well. Loss of the peptide market. A peptide, by the way, it's an amino acid. Peptide, insulin is a peptide. The GLP-1 antagonists, or the semaglutides, the Ozempic market, Mounjaro, etc. These are all examples of peptides that have been patented for commercial use. But peptides and amino acids exist in every cell. That being said, there's been a ton of research and a lot of work being done within the biohacking community that is starting to spill into the mainstream. These are becoming, maybe not tableside conversations, but the horse really definitely feels like out of the barn. With the incoming administration in the U.S. and Robert F. Kennedy coming in as the new health czar under Make America Healthy Again, I think we're going to see some really interesting dynamics setting up in that segment. Peptide therapies have been used for over a century to treat metabolic illnesses and offer numerous advantages over traditional small molecule drugs. And they're becoming one of the fastest growing and most lucrative trends in medicine today, with applications in personalized treatments, biologics, anti-aging therapies. And the peptide sector is projected to exceed $100 billion by 2033, making it a high growth area with significant investment potential. As I mentioned, the recent election of RFK as part of Make America Healthy Again initiative has brought peptide therapies into the spotlight. RFK has threatened to dismantle and overhaul the FDA, which could lead to a more favorable regulatory environment for innovative therapies. The shift could accelerate the adoption of peptide therapies, providing solutions to the ongoing health crisis in the US and globally. Peptides really are an existential threat to pharmaceuticals. As doing some research within the space and spending a lot of time unearthing opportunities and looking down the fairway, one of the big reasons why peptide therapies, they've had a ton of studies to them, but one of the reasons that they've been effectively kept away from the market without FDA approval, you can imagine through heavy lobbying efforts throughout the US, the pharmaceutical companies don't want these things to come to the forefront. You cannot application patent an amino acid or a peptide under 50 bonds, chemical bonds, as I understand it. I think about 97% of identified peptide therapies fall underneath that 50 bond hurdle rate, making them not patentable for application use. And as such, they've been kept out of the marketplace. Peptide therapies do have the potential to improve health outcomes for millions of people by enhancing cellular regeneration, reducing inflammation, and supporting overall longevity. Look at the wave that the GLP-1 antagonist market has made into the U.S. Ozempic is seemingly it's like the new cool thing. I was speaking with one compounding pharmacy, a private pharmacy in the U.S., and they are selling over $60 million a month of semaglutide, which is Ozempic, just into the state of Florida per month. These are big numbers we're talking about, and that's one product SKU. This represents a huge economic opportunity and something that we're watching closely. But as the healthcare landscape evolves, and as these peptide therapies remain an existential threat to big pharma, which has traditionally relied on small molecule drugs, investors should consider the potential of this emerging thematic, as it offers an opportunity to capitalize on the transformative impact of peptide therapies on human health and longevity. I've taken a lot of time, guys. In summary, the market's shown a lot of resilience despite challenges posed by interest rates through the election cycle. The alternative private income portfolio has delivered its first quarter. I'm very happy about that, providing our clients with stable income and growth. As always, we remain committed to navigating the ever-changing market landscape and delivering the best possible outcomes for our clients. Thank you for tuning into this episode of MLD Money Matters. And if you have any questions or topics you'd like me to cover in future episodes, feel free to reach out. Until next time, stay informed and stay invested. Have a wonderful day, and Merry Christmas and Happy New Year to all of you. Talk to you soon.